You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts Alex the Viceroy Jacobson from Options Express, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionFit.com. The Option Block is brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
Welcome back, everybody, to the Option Block. We are, of course, everyone's favorite bi-weekly choice for all things options related. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-exciting Options Insider Radio Network. As always, check out our new editions, Options Playbook Radio, and indeed Trading Tech Talk, to dive into all the cool stuff offered by those programs, institutional technology on one side and some retail education on the other. So we're really mixing it up with the new additions. And while you're checking those out, of course, check out our brand spanking new mobile app available for iOS, Android, and Kindle Fire. All the platforms you may need. I think you're going to like that app. All right. And joining me on the program, Uncle Mike Tusaw, on a much-deserved vacation with the old family in the mountains, I believe, the Smoky Mountains, ironically. So we are a man down, but none the worse, for we're starting off beaming in from the great state of Maine, none other than the Rock Lobster himself, Mr. Andrew Giovinazzi.
A thrill to be here. Hugely thrilled week after week.
All right, and also joining us, beaming in from the Mecca of options, known as OX by Charles Schwab, none other than the Viceroy himself, Mr. Alex Jacobson. Mr. Alex, welcome back to the show, sir.
Good to be here, and a lot of news to discuss in today's show.
A lot of stuff to discuss. So let's get right to it with the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
All right, welcome to the trading block. This is, of course, the portion of the show where we break down what's moving, what's lighting up the old tape, what's going on in the old marketplace today. And it was a relatively strong day to the upside. Most of the major indices closing up 0.5%. We are recording this today, listeners, May 29th, Thursday. So bear that in mind when you're playing the home game. S&P up about 0.5%. Q's up a little bit more. Dow up a little bit less, but otherwise most of them pretty much following suit. VIX cash essentially unched on the day. I know if Uncle Mike were here, he'd be saying, woohoo, woohoo. Apple up nearly 2% again today to close at 635, up nearly 12 handles today on the day. Of course, he may be a little bit less excited about what's been going on out in GLD of late, so maybe he'd be a little bit more tempered in his excitement. Mr. Andrew, what has caught your eye in today's activity in the old marketplace? Ye old market, if you will.
Well, it feels like sort of an all Apple, all day market. I think we're trading 605 at the beginning of the week. I'm pretty sure.
These iWatch rumors are bumping them up another almost 5%.
Exactly. You've got the conference next week. I thought it would rise a little bit. clearly not thinking this much. So I had to close some stuff down today just from, it wasn't bad. It was mostly annoying. I just didn't want to be short, but when it keeps going up, yeah, it was 6. It was the at the end of last week, it was trading 505. So it started touching some stuff. And with this conference, I expect a rise. I expect the vol to go up a little bit. And usually then they announce whatever they announce and it falls back. But this is the largest rally I can remember prior to a product launch in here. So, I'd have to say it's getting a little funky, a little jiggy. Have no idea. Maybe they're finally going to create a new product after the iPad. I don't know, but they've been talking it up. If I had to guess, everybody would go, oh, we have another iPhone. Great. Maybe something else, and it's back to 600 again. Who knows? But for right now, it's showing some pretty remarkable strength. So, and I think it just dragged a lot of stocks up with it. Because we had a rally today with almost no help from any of the bank stocks. So maybe, when all the CEOs just poured cold water on everybody and said there'd be no, we weren't going to really make any money this quarter because there's no trade. So, but anyway, it feels like a low vol market, and at least for right now, it should be, because all we do is go up 0.5% every day. Pretty boring, but that's enough to drive some volatility pretty close.
If you're long, it's pretty exciting, I'm sure.
The long stuff is doing much better than all of my short premium. Let's put it that way. So,
Mr. Andrew, some news coming out this week, and 2 products that you're somewhat interested in, maybe one more than the other. Of course, SIBO, the source of both these announcements. First off, we have half strikes coming in VIX options, which I think would be interesting for you guys and for a lot of your mentees. And perhaps a little less interesting, but still interesting in and of itself, is the SPX adding end of month options. These are quite literally the last day of the month, listeners, to kind of coincide with the timeframes that a lot of money managers like to do to rebalance their portfolios. Either of these announcements lifting up your skirts over there at Option Pit, Andrew?
Not lifting them high enough. I think, it's another bunch of interesting terms to add to the mix. It might make the VIX a little bit more interesting to trade with the half point. You could probably play a few more games going into the expiration that way. And, be a little more granular with what you want to do. The SPX end of the month options, for a fund manager, great. I mean, the fund managers that we have probably will like them. They'll just, integrate them as is. So, it'll be good for Sebastian, probably at Swan or something like that, but makes it a lot easier. But nothing to really get my skirt flapping. Let's put it that way.
That skirt of yours, it's hard to blow it up these days. You're a bitter man. All right, and Mr. Alex, what caught your eye? What was lighting up the old tape over there at OX today?
So a number of things were active today, and I think, the industry all talks about Apple as kind of being a bellwether, but I think there have been a stealth rally here in momentum again. It looked like everybody was buying Twitter and buying Twitter options when it got into the low 30s. I know it got a couple upgrades today, but Twitter was active in both the stock and the options on our desks. The other thing that's been going on, and this is why I think there's been this stealth rally, is if you look at some of the other momentum names, obviously Netflix today had a big day, and talking a little bit, that was kind of the hot topic on OX Social today. But if you look at the other triple-digit names, Amazons and things like that, there's been a real stealth rally in them. Amazon, in the last couple of weeks when they were banging the momentum names, got down into the high 280s, 290 area. It's up almost 25 points from that. So, as I say, Apple's clearly the most visible name out there, and that's what drives a lot of the NASDAQ traffic. But momentum in general has come back. I've been bullish. Mike and I are always, Mike always does his commentary about there's never a better time to sell. I've been bullish. I think there's a lot more left in this market. I think Dow 17,000 is reachable here. I think rates are going to continue to go lower, and we'll talk more about that in in a bit. But the public, everybody talks about, has the public been in or been out? And the great thing about being part of Schwab now is there's a much bigger kind of population to look at, and the public seems to remain committed. Now, doesn't mean they're all trading options. Some are doing, more fundamental trades, index funds and their 401ks and things like that. But this rally seems to have the public behind it. And that's something that we haven't really seen for a while. The other thing that was keeping the desks active today was futures picked up again. And the futures desks has sort of been kind of feast or famine. And what kept them hopping today was the grains were getting hammered. Gold, there are a lot of people in gold who still don't seem to be exiting yet. So there was some hedging going on. There was some trade in both the future itself, the futures options, and the GLD. The other thing that's been active on our desk has been coffee, which is up. I think the futures guy said something like 70% in the last few months. So you've got gold that's lost 5 or 6% in the last couple of months, and coffee that's up 70%. So there's a lot of stuff to trade. There's from the standpoint of the folks who do want to trade, there's just been a lot of trading opportunities. And, what we saw today was sort of atypical, a good market, volatility coming out a bit, interest rates stabilized today. I mean, yesterday was amazing in the 10-year. Yesterday we had a 50 realized vol in the 10-year, and you just don't see that kind of stuff. But a good market overall and a good trading day.
Yeah, you said where Apple goes, the market and the volume tends to follow. When Apple rallies north, the market follows behind, and volume tends to follow with it these days. It's just the all Apple all the time market these days. But you did mention one of the other big names, and I tend to think of these two in similar frames of mind, because Apple certainly has diehard devotees out there, but the gold bugs are probably only second to the Apple folks in terms of sheer fervor for that name. And like you said, they're still kind of refusing, a lot of them, to give up the ghost. A lot of active hedging, which is of course good for you guys, good for volume. But like Apple, the gold folks, whether it's in GLD or in the futures or futures options, they're going to cling to that underlying till everything is pretty much wrung out of it. So it doesn't surprise me to hear that a lot of the OX gold traders still bullish and still expecting another move to the upside. I'm sure if Tusaw was here, he'd probably still be bullish as well. So there's those gold bugs out there, and nothing seems to be able to dissuade them of the inherent value of that commodity. You mentioned also volume earlier. There is some interesting stuff coming out of that space. You said things have been good for Schwab. Of course, some analysts have been looking at the space lately. They kind of lumped you guys in with some of the other names like E-Trade and with TD Ameritrade, saying that the volume at Schwab, E-Trade, TD combined increased 24% in the first quarter from the previous year, hit its highest level ever. This is according to an analyst over there at Raymond James who follows the sector. He also talks about some of his other data points, but that daily average revenue trades, or DARTs, which if you're in the business, that is the lifeblood of the brokerage business, and that's what's up to its highest level ever in the first quarter. So all this talk about retail staying away from the markets, that this rally being done on relatively thin volume, that people were afraid of the rigged markets post Flash Boys, all this stuff doesn't seem to be translating into the actual volume. I know you've been saying that for a while now, Alex, that things are still strong over at OX, and here's some outside data kind of backing you up on that.
Yeah, in all honesty, there is sort of a calendar issue there. The first quarter really was terrific. April was slow, and I've tried to not kind of disguise that on the show. April was slow, and April was slow for obviously the street. May has been terrific, and this late May has just been extraordinary. And of course, whenever I quote that, somebody says, "Is it weeklies? Is it?" And the thing is, it's everything. Yes, some of it is weeklies, but some of it is just the confidence is back. Everybody talks about the VIX as a fear gauge. In fact, I worked with Stephen Sears, the guy who gave it the name, the fear gauge. But one thing you got to think about is that then a low VIX has got to indicate some high level of confidence or lack of fear. Now, it's not quite that black and white, but what we're seeing is, and Andrew talked about this a little bit, there aren't a lot of places for money to go. I mean, yields are falling. People are rushing into treasuries. And one of the things, everybody talks about how's the Fed going to unwind and things like that. With an aging world population, and I hate to sound like an economist here, but I now work for a company that has economists and analysts, so I actually read much of what they produce. But with an aging world population, the demand for sovereign debt is just going to grow over the next few years. And it's not speculative demand. It's going to come from places like Japan and parts of Asia, where the core retirement portfolios are, U.S. debt securities. The other thing you see in Asia is they tend to buy big cap tech a lot when big cap tech is popping to new highs. So traditionally, they've been big buyers of the Apples, the IBMs, the Intels, and you're starting to see some of that again. So it's kind of interesting here. I remain very bullish. I think rates will continue to fall. And I've changed my mind on that. And I've talked about this. I mean, we've all talked about this. We would have bet a year ago that the 10-year would be 3.25, 3.5, something like that here. And, it's bumping 240. So money's running into debt. And people who see low volatility are buying equities. And as Andrew talked about, they're buying equities. They're writing covered calls. They're buying equities and collaring. Some are just buying equities. The in-the-money leaps trade has picked up lately, especially in some of this triple-digit stuff, which is a risk-managed way to play it. And, instead of buying $650 Apple, buy a leap, $10, $15 in the money. If it drops, you sell some short-dated weeklies against it. So we're seeing a lot of that again, and it everything just kind of feels right. Now, of course, anytime I say that in any kind of conference call, somebody comes up and says, as a contrarian, that's the making of a bubble. And you're not going to forecast bubbles. And there's an awful lot of cash still in the hands of U.S. corporations and even U.S. investors who've come in. There's still a fair amount of cash on the sidelines, and I think we're going to see more days like this. I think we're going to continue to go higher.
You're right, Alex. There is a lot of that in the air these days. I didn't realize Steve Sears was the Queen E of the fear gauge phrase. I always attributed that to the SIBO folks. Perhaps I should lay that at his feet. But a lot of people throwing around a different moniker for it these days. They're starting to call it the complacency gauge. A lot of people really fixating on these low levels in the VIX cash. As we record today, the VIX cash off about 0.11 to about 1160, 1157 or so right now. And a lot of people also making a lot of hay out of the fact that VIX, always being call heavy in the options, is extremely call heavy, is in historic levels these days at 3.3 to 1 on the open interest. Usually it hovers somewhere around, I think, 2.5 to 2.8 to 1. So these are very high levels. Of course, as we discussed on our Volatility View show in the last few weeks, a lot of that could be probably laid at the feet of the actual structure of the index itself, where you're just at such a low level that there's fewer strikes to actually trade puts in versus a legion of strikes for calls, and also fewer people looking to speculate on a move from 12 or so down to 9 than there are people looking to speculate on a move from 12 to 20. So people just tending to pile in on the calls from a structural perspective, if for nothing else. So maybe that probably attributes to a lot of that very, very heavy weighting on the call side of the VIX fence. All right, and that is going to do it for the trading block. And now it's time for us to keep on rolling right on into our next segment, the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
All right, and welcome to the Odd Block. This is, of course, the portion of the show we break down the interesting, the unusual activity that's lighting up the old tape. Going to kick things off with EWA. This is the iShares MSCI Australian Index ETF. Closing today, $26.74. A name that does about 1,000 contracts a day. Doing a whopping 3,000 today. The bulk of that, 2,000, coming in an interesting risk reversal. Mr. Rock Lobster, walk us through what caught your eye out here today in EWA.
I think the way that this was trading was twice as many puts over calls, went up as a spread, and it looked like basically a closing type of trade where they had sort of the long, they are long puts and short calls, and against probably what it looked like an equity position. You kind of had to move up. And they're just closing it because they made money on their underlying. I think it's one of those trades where they're probably protecting themselves in case, something bad was going to happen. And, well, the market went straight up. So I would see this as a closing transaction. I'm 90% sure, but you should check the open interest tomorrow anyway. But just looked like the unwind of a risk reversal. A weighted risk reversal because you had those extra puts.
Yes, exactly. They did a little bit on a bit of a ratio here. All right, next up in the old Odd Block, we have a newcomer. This is Scientific Games Corp, ticker symbol SGMS, closing today $9.06, down about 15 cents on the day. Now, this is the name that does, about 600 some odd contracts, doing over 3,000 today, so about 5x its ADV. And the bulk of that coming in one, I guess what you expect these days for the Odd Block, most of the Odd Block names anyway, upside or near upside call buys to the tune of 3,000 of the OCT10 calls going up for about $1.05. All went up in pretty much one block, at least 2,500 of that 3,000 going up in one block. 2609 open on the strike, so possible that is closing, but it probably leaning towards the opening side of the equation. Is that the side of the equation you fall in as well, Mr. Rock Lobster?
I think so, because the way the volume looked was they lifted the small contracts at $1, like, kind of pinging all the exchanges for $1, then printed a bunch at $1.05. And that was more volume than what the open interest was, although the open interest was substantial. So it just looks like somebody wants to get long at the bottom to me. And they're picking, I would say an October 10 call has a pretty good shot with a junky little stock like that, to make some money. So when vol's low, you're seeing a lot more people buying this just kind of at the money call or just out of the money call, looking for a bounce in some of these stocks going, 4 or 5 months out. Because you're getting a lot of bang for your dollar at this level with the vol so cheap.
Speaking of October activity, that's where all the action seems to be today in the Odd Block, including in another newcomer, Ambev. This is ticker symbol ABEV, closing today $7.20, roughly unched on the day. This is the name it does, again, about 600 contracts a day, doing about 4,000 today, so some sizable volume going up in ABEV. When we profiled it on the site, we profiled 700 of the OC 7.5s going up for 30 cents. A total of 1,500 actually went up on that strike on open interest of about 800 contracts. It looked initially like this was an at-the-money buy rider coming in to harvest a little bit of yield, around 5%. Later on in the day, though, we did also see some of the July 7.5 puts going up 1,500 times as well on 3,500 contracts open interest. So could be perhaps someone legging in to a risk reversal, perhaps a little collar legging in going on in ABEV. Is that your take as well, Senior Rock Lobster?
It could be a take. It could be a take. I think the stock doesn't move very much. And by the way, this is the beer the girl from Ipanema drinks. This is from Brazil, this company.
There we go. A ringing endorsement if ever I heard one.
I'd like to have a beer with her one of these days. Oh, sorry. I was digressing. But this looks like just straight up kind of buy right yieldy type play. Get 5% to October, you sell the calls for 30 cents. The stock's had about $1 range, I think, in a year. So okay, I'm an owner of this ABEV company. I'll just sell some calls, take my couple bucks and go. I don't think this one was hugely complicated, but again, probably, you buy a cheapy beer company in Brazil, the market's kind of, it's sold off a little bit. I think it's not a bad way to generate a couple of bucks, better than probably not as safe as a CD, but you're getting a lot more yield. People are going to drink beer in Brazil no matter what happens, I think. And probably more going into the Rio World Cup games.
All right, and that's going to do it for the Odd Block, and now it's time to roll on into Alex's favorite segment because it's time for the Xpress Block.
The Xpress Block, brought to you by Options Express by Charles Schwab. Options Express by Charles Schwab lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources. Options Express by Charles Schwab is the online broker for all traders. Best of all, Options Express by Charles Schwab lets you trade stocks, options, and futures all in a single account on powerful yet easy-use trading platforms, including mobile devices. Visit optionsexpress.com for your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome to the Xpress Block. This is the portion of the show where Alex takes the reins and takes us on a behind-the-scenes tour into the land known as Options Express by Charles Schwab. Alex, we're actually going to kick it off with perhaps a somber note today in the Xpress Block. You and I, in particular, on this show in the past have gone back and forth discussing the fate of the mini options, and with a lot of that being on the doom and gloom side of the fence because it didn't really look that good for their chances. Listeners, again, I encourage you, if you want to hear more perspectives on mini options and why they may have failed, I encourage you to tune into our industry coverage, our interviews from the Options Industry Conference, where I got to talk to a lot of exchange leaders, brokerage firm heads, to kind of get their perspective on why these interesting products failed, as well as a bunch of other discussion topics. You can find all of that in our main network feed, as well as in our Options Insider Radio feed, our main flagship interview show. All right, and so Alex, as you and I were discussing yesterday, there was some news on the mini front yesterday. In particular, I'm going to read this notice that came out of NASDAQ yesterday for our listeners, and then we could pontificate on what we think this means for the future. NASDAQ came out with this notice yesterday saying, effective at the opening of business on Wednesday, May 28th, again, that was yesterday, NASDAQ OMX Philex and their options market and OMX BX options will no longer add additional series to the mini options. So that's, of course, Apple, Amazon, GLD, SPY, and Google. There shall be no restrictions on opening transactions in the mini options, and therefore such options will not be limited to closing transactions only. So they're not delisting them per se, but they are saying they're not going to add any more series or names to this. And then we know in the exchange space, whenever one exchange gets the ball rolling, knocks down a domino, the others are quick to follow suit. So Alex, are you in the same camp that I am, that this is pretty much the death knell here, the official death knell for minis, and it's just a matter of time at this point?
Yeah, it's clearly the death watch, and I think we've all been pretty candid on the show about minis and how the industry really didn't do a good enough job of supporting the product. And this is kind of a classic example where there was a good product and you can kind of fill in the blanks. The market makers didn't support it. The brokerage houses didn't adjust commissions. The reality is the industry doesn't support things that don't get traction right away. And, it's kind of this catch-22. Market makers will say, if there's paper, I'd have better markets. And brokerage houses would say, if you had better markets, there'd be paper. I'll get on the soapbox for a minute. Yes, this is the death watch for minis, but I think the industry should consider doing something that we tried to do with the ISE that we did not have good success with, and that is create what we call the second market. And the second market is simply a market. The quick way to think about it is without market makers, and just let customers go in and post bids and offers and host that. Now, it's not that easy because of NBBO guarantees and linkage and things like that. But back to things that the regulators should look at, they should look at giving customers the ability to create liquidity here. Everybody talks about, I've been in the business a long time, so I remember sows bandits and the raise bandits, and everybody talks about how they add liquidity, and generally the sows bandits and the raise bandits were adding liquidity where they didn't need any liquidity. It's very easy to say I'm adding liquidity in the spider. The spider doesn't need any liquidity, but what minis needed was liquidity. And the industry should look at creating a quote unquote kind of second market or a billboard. Structurally, the exchanges don't compete that much anymore. And I know that's a comment that's going to get me a lot of unhappy emails, but I was someone who spent almost 2 decades at the SIBO, went out to go help found a new all-electronic exchange, and the landscape changed, and things got multiply listed, and things got competitive, and stuff traded in pennies. And yeah, there are a handful of instruments that are really liquid today: spiders, Apple, VIX, SPX, things like that. But there's a ton of them that aren't. And there's this grand catch-22 that if we could get some more liquidity there, we would see a lot of business. And, I get on my soapbox and I call on the exchanges to do something. And some of these innovators, Box, Miami, some of the little guys, that would be a great place for them to try to carve out a niche. But the challenge they'd have is the same challenge, Box had with the jumbo spider. Other exchanges didn't want to list it because that would have put it on ITS, and everybody would have been able to hit it. And the exchanges elected not to compete. And the jumbo spider, which I think was a terrific idea, has no liquidity in it. And I don't know how much longer it will be supported, but folks in Washington should look at that and see if they can put a spark under the exchanges to do a better job of this stuff.
I did talk to those Box guys down at OIC, and they did say that they are continuing to support and investigate the SPY, but they're not making any changes, or the jumbo SPY, I should say. But they're not making any changes right now to the contract, and it doesn't seem like they're too optimistic on any volume coming that way anytime soon. To go back to your earlier point for a second, I am somewhat surprised to hear you say that ISC was investigating this idea of essentially some sort of customer order book like that, a limit book that you could use. Because whenever I've approached that idea to Gary Katz, the CEO of the ISC, talking about after-hours liquidity and using the customer liquidity as a way to set that up, he's always been adamant against that it wouldn't be a good experience for the customer. You need market makers to really maintain the market, et cetera, et cetera. So he's been vociferous in his opposition to that in the past. I'm surprised to hear that they were investigating something similar for some of these illiquid names during the day, at least, but still a similar type idea.
Yeah, well, we did it, but this is the structural impediment in the industry. I mean, we talk about after-hours trading all the time, and if customers had here, look what the CME does in after hours, and you say, well, sometimes liquidity is good, sometimes it isn't. But there is a venue for it, and customers could post quotes. And, we're going to fight this after-hours battle until somebody decides to be a pioneer there. And the problem is it's structural. The way the OCC board is structured, any of the big exchanges can veto a major change, which means, look, exchanges operate in their best interests. They're public companies, and they operate in their best interests. And as you heard Blair Hull say when he was on, there are structural impairments here, and there's Rig NMS and things like that. I've talked to market-making firms. I've worked with market-making firms, and for them to stay open extra hours isn't that expensive, especially if you just do it in a couple hundred names. The exchange's gripe about staying open extra hours, I continue to think is bogus, with the exception of a pit-traded product. With the exception of the SPX or the VIX, that would be hard to do because it's a pit-traded product, but wouldn't be that hard to switch it over to the electronic or C2. Not sure if C2 has a future, in non-regular market hours, and you look at what the CME has done with that, and they've done well with it. But let's talk about why the CME has done that. They trade 100% of the volume in their names, and the exchanges, again, with the exception of SPX and VIX, the exchange's liquidity is fragmented. If you're watching Bloomberg or CNBC today, there's an IB ad on today with Pettifree in it, and Pettifree's a very smart guy. I have a tremendous amount of respect for him, and this whole ad is about how IB helps you in an environment where there's fragmented liquidity, and it's a clever ad because he's hitting at kind of the soft underbelly of what's wrong with the options market, and we need to change it.
You know, you're right, Alex. There is a lot of debate, and you and I have certainly debated in the past about the after hours trading. We've come down, I think, on the same side. I think you and I are both in agreement that a subpar experience is better than no outlet at all for any retail guy, which is what we have now. I think the industry tends to lean the other way. They say it has to be exactly equal to the quality and liquidity of the intraday session, or we shouldn't do it, which I think that's a very backwards assessment. But c'est la vie, we've had that debate in the past. I think we'll continue to do so many times here on this show until someone, you're right, until someone has the fortitude to try to be a pioneer in that space. Really quick before we move away from the minis, your tenure predates mine in the options space, Alex. Have you ever, in your time in the options market, seen a product go from concept to big buzz to fast track approval from the SEC to listed to essentially dead in such a fast time frame, a little over 2 years, and it's all pretty much said and done for the minis?
I'd want to think more about that, but I don't recall. There were a lot of products that didn't take off at first that got great traction. SPX, first time SIBO listed it, failed. And it was delisted, reconfigured, and brought up again. OEX was the big trading product. Ironically, OEX, which you could say built the building and made a lot of trading fortunes, now is a product that hardly trades at all. So things evolve, but the experience with minis, I can't think of a similar experience in the past.
Yeah, certainly not one that had so much industry hype behind it, had multiple exchanges competing to create it and shape it, and getting such approval from the SEC so quickly, and then bam, just dead in the water. It is certainly an interesting lesson. I'm sure some case studies will be done on this down the road, and people out there studying the financial markets and new products and how they succeed and perhaps don't succeed these days. Interesting stuff. Alex, we have a lot of listeners who want to join us here on the show, so I think it's time for us to rally on into our next segment, my own personal favorite, probably yours as well. This is indeed the Mail Block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, listeners, welcome to the Mail Block. This is the portion of the show where you guys get to join us here on the old All-Star panel, make your comments, your questions, your insight heard and shared with your fellow listeners. Alex, this first one's for you. This comes from our good friend, Mr. Kaiser Dog. He writes into the show on occasion. He wrote a very long series of questions and comments here. I just truncated the first part for you here. He wrote, I enjoyed today's podcast. I felt the Viceroy came back with some very pertinent information. I have been using my iPad and even my iPhone a few times to initiate trades. The mobile trading option is gaining traction, and I agree with Alex's sentiment that this has smoothed out trading flow, especially in times that would be historically light volume. I myself prefer my laptop trading station I have custom built. With that said, the reality is that raising a 4-year-old son takes a lot of time and attention. I can commiserate there, Kaiser Dog. My mobile app, he goes on to write, allows me to stay on top of things and still be a parent. The mobile trading option is a huge success, the polar opposite of, quote, mini options, in my opinion. I enjoyed the swing to a positive story from the depression that HFT and Minis caused me. Laugh out loud. He's, of course, referring to our episode from a few weeks ago where you were talking about mobile functionality, Alex, and we also talked about the minis and potentially weighed in on whether or not they were going to be around much longer. Of course, we saw the end result of that today. He also related a pretty interesting story about his lack of success with the minis and how the spreads and commissions really crushed him. But interesting stuff. And here's someone here, Alex, who's weighing in and supporting you on the mobile side, that people are actually doing the lion's share of their activity on the mobile for a variety of reasons. This guy has to raise his son, but other people just like the portability of it. And the days when someone used to just log in and check a quote and that was it, maybe check a chart, now they're actually constructing trades and doing analysis on the mobile. And that's something I don't think anyone really foresaw just even a few years ago.
Yeah, and I actually sit next to the mobile team, and Idea Hub, my offspring has gone up on the Schwab mobile app in sort of a light form, but the next thing you're going to see on the Schwab mobile app is later in the year, much later in the year, you're going to see multi-leg spread trading. You're going to see the all-in-one trade ticket. And, as we talked about on the show, some people are embracing it, some people aren't. The folks who embrace it use it a lot. And I know some of the commentary from both Mark and Mike is, yeah, but you're not going to see customers banging out a 500 lot or a 1,000 lot. And the only thing I can tell you is, yes, you are. And especially, I know what goes on at OX and what goes on at Schwab. And one of the things at Schwab is, under the current structure, you pay to use the trade desk. You don't at OX. And I'm sure part of what drives mobile are the favorable economics that I don't have to reach out and call the trade desk if I'm remote. But I also talk to, my friends on the street, and the options business, as we found out this week, is becoming a smaller community, and folks who relate to mobile are paying for it. They're suffering from a business standpoint. Will a client leave a brokerage house because they have a not as good of a mobile platform as someone else? The answer is yes. Yeah, they will leave. Clients love high quality tools. A lot of people think price is everything, but that's not the case. It's a value equation. And the great thing about the brokerage houses, especially since electronic trading, multiple listing, and I'm going to include payment for order flow, but since we started the ISE in 2000, the investment by the firms, a lot of it has been in quality trading tools. Now, a lot of it, you talked about $half strikes in the VIX and things like that. Those are interesting innovations, but those are the things that keep trading costs high. Because what happens is the firms have to reprogram for stuff, they have to change stuff, and as we saw this week, two terrific brokerage houses, but very low cost delivers of service couldn't survive under their traditional models. And I talked about this last year where I made the forecast that I thought 3 or 4 brokerage houses would go away in 2013. One did go away in 2013, and 2 were consolidating in 2014. But it's getting very hard to compete if your model is simply trading and you're going to be a low price producer. And I can tell you, if you really want to peek behind the curtain of the brokerage industry, almost everyone who's left in kind of the low price space is either for sale or looking for a business combination. Now, I know tomorrow I'm going to get 100 emails screaming at me for saying that, but that's the current state of affairs. And, we saw this week Option House and Trade Monster essentially being sold in a consolidation effort, being bought by a private equity firm. 2 terrific firms, 2 really terrific firms, but with very low cost delivery. And the reality is it was tough to make money. Last year we saw Zecco and Trade King. Zecco was the original trade for nothing, and that comes up a lot. There's a a firm starting up now called Robinhood that's going to be free stock trading of market orders. And you say to yourself, how do these people make money? And you say, well, some of it's payment and some of it's they charge for other things. But the other reality is some of them aren't making money trading. And you're going to see more evolution and consolidation in the industry.
Since you touched on it, let's bring out this next listener question here. Very timely one from our listener. It goes by the handle De Gaulle. He writes, maybe writing from Paris. I don't know, maybe writing from France. He writes, what does the option house trade monster merger mean for the options brokerage landscape going forward? Alex, you just weighed in on it a little bit. For those listeners who may have missed the announcement somehow, like Alex just said, these two, I suppose you can call them smaller options brokerage firms, they decided to merge. They're actually, one was wholly acquired, the other acquired a majority stake in by a private equity firm, and then they combined the resulting entity. I believe it's keeping the monster name. I'm not sure if they're keeping the options house name. I'm not sure exactly how that's going to be shaken out yet. But you're right. It does pose a lot of interesting questions for the brokerage realm going forward. Of course, you guys, Alex, really got the ball rolling. You guys and TD, of course, with your deal with Schwab and TD's deal with Thinkorswim, kind of bringing two large equity-based and advisor-based shops, showing a lot of interest and spending a lot of resources to become big players in the option space as well. And that kind of shows what kind of resources you really need to bring to bear in the space to A, be competitive, and then B, be able to keep up with the demands and needs of the active retail options trader. You guys may not realize if you're pretty demanding clients to have to really work with. You demand a lot of bells and whistles on your platforms, a lot of tools. You want them all for free. You don't want to pay for that stuff. And like Alex said, that's a lot of R&D expense. And I think if you look at a lot of the comments coming out of that merger from the two different firms, is the costs were just prohibitive for them. In order to keep a brand spanking new platform with all the bells and whistles, cutting edge, that's a lot of R&D money. You have to go out then spend money on marketing to acquire new customers. A lot of the traditional sources of brokerage revenue, like commissions, those aren't faring that well these days. And if you're a low cost provider, they're even worse. Margin, which is a big profit center for a lot of the brokerage firms, we all know how that's been doing over the past few years. So this is a difficult environment. And I think what you're seeing here, Mr. De Gaulle, is just the realities of the space. You have big players playing in the space now, bringing a lot of resources to bear in the option space. If you're a smaller player, you need to consolidate to survive and to try to affect some of those same economies of scale in order just to be competitive. Alex mentioned the Trade Kings Echo merger. That was one of the first ones. This now with this combination doesn't leave many standalone players. I'm not familiar with that Robinhood firm you mentioned there, Alex, but sounds like they're doing the exact same models Echo did, which was free market orders. And I shudder at that notion. The idea of free market orders just sounds to me like they're going to rob you blind, but maybe we'll leave that for another day.
Let me tell you a story somewhat out of school, and even the people I report to every once in a while dope slap me and say, could you back off on that? So, but I will tell you the story. I pulled the PDF out, the 2006 PDF, the document that was attached to the filing when InvestTools bought Thinkorswim. And one of the things they showed in the document was who were the lowest cost producers. And the typical cost to do a DART, the typical cost to do a ticket is still close to $10 in this industry. So you pause and think about that for a second and say, okay, so stock trading is $6.95, $7.95. I think at Option House it was $4.95. If the typical ticket is $10, how do you make money? And the answer is pretty clearly, even if you're getting some payment or rebate, you don't make money. When we started the ISE in 2000, payment for order flow in the equity space was probably in the neighborhood of 80 cents a contract. And at 80 cents a contract, prices fell. Schwab, prior to 2000, was $29.95 and $2.50 a contract. And when I quote that, everybody's like, you sure? When I worked at Merrill Lynch in the 80s, it was as much as $14 and $15 a contract if you were trading a 10 lot. And if you were trading one or twos, you had $50 and $60 minimums. So it's a value equation. It's not a price equation. And the folks down in the 50 and 60 cent level can't make money. You say, well, they'll make money on margin. Ironically, the quotes at the 50 and 60, the folks at the 50 and 60 cent level are also the ones lending money at a percentage point or two. You know, I talked about how much I respect Pettifree, and he's running these ads now about fragmented markets. Pettifree took a $250 million hit last year on unsecured debit and currency translations. You say, well, he's got a big balance sheet, and, you know, that's going to happen every once in a while. And I tell you what, after one of those, you turn around and say, what businesses should I jettison and what businesses should I stay in? It's very hard to compete with Schwab, TD, E-Trade, and Fidelity, because a lot of times a new tool, by the time you deliver it and develop it, is going to cost $500,000 to $1 million. And you say to yourself, how? If you come up and visit the OX office, we have about 230 people working here in Chicago. And you walk in, you say, what the hell do all these people do? And you realize some of them are developers and some of them are risk and some of them are margin. But the risk department, you know, the folks who look at risk, a lot of that stuff can't be automated because you have covariances. So it isn't only the way things change as the S&P change, it's the way Apple changes when Amazon changes. And you know, you have the innovation of portfolio margin. And, you know, one of the things people gripe about with portfolio margin is, you know, why do I have to have 100 grand or at some firms 150 grand? And the answer is because it costs us more, and we're not going to give portfolio margin to someone who can't trade enough to cover the expenses. So it's a value equation. House and Trade Monster were two extraordinary firms, and I candidly hate to see them go, that consolidate. You know, I was at John Nigerian's wedding. He was at my kid's bar and bat mitzvahs. He's a wonderful, terrific guy. And I will tell you, when John started Trade Monster, he said that they had a media consultant come in, and they valued the fact that he and Pete were on CNBC as the functional equivalent of, I forget if the number was $4 million or $5 million a year in advertising. And you say to yourself, you get a sense of what it takes to run some of these businesses now. And when you can consolidate costs, when you can combine two firms and say, look, we're only going to have one risk department, we're only going to have one piece of real estate, you begin to realize why there's going to be more consolidation in the industry.
Great stuff. I think there's maybe on another show we'll have to get into some of those DART numbers in a little bit more detail, because that's fascinating stuff as well, how the ticket charges are still so high. But unfortunately, that's all the time we have for the mail block this episode. Great questions, everybody. Keep them coming. And now it's time for us to roll on into our final segment, Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, and welcome to Around the Block. This is, of course, the portion of the program where we tell you what we're watching, what we're keeping an eye on for the rest of this week into the old weekend. Mr. Andrew, let's start with you. What are you watching this week? What's catching your eye? What's on your trading screen?
Again, watching Apple, see if we could set up something for some kind of a move. Again, watching how low VIX can go, and see if we can get any kind of bounce back in the financials. Gold just feels done. I don't know. It's ugly, ugly, ugly. And it just feels like everything that everybody thought is wrong. Like yields, they're going higher, wrong. Gold going to the moon because of inflation, wrong. Stocks can't go any higher, wrong. It just feels like everybody's sort of unwinding the wrong trade over the last week. And it's worked out fine for most part for us at Option Pit, and but because mostly we haven't fought it. We haven't fought the gold, haven't fought treasury bonds, and haven't fought the market going up, because it kind of is silly when it keeps going in one direction. But it's what it feels like today especially. It's like This is the unwind. So that's just watching to see how low these yields can go. I mean, it's quite it's like nobody wants to buy stocks. They're going to all pile into bonds, but somebody must be buying stocks. So it's a very interesting, just keeping the powder dry, looking for cheap volatility, and just not getting too short and not getting short at all. Actually, trying to stay a little long and owning some juice at the same time.
All right. Thank you for that, Mr. Rock Lobster. And Mr. Viceroy, what do you keep an eye on for the rest of this week, sir?
Macroeconomics in the 10-year. We got GDP numbers. We'll get adjusted GDP numbers tomorrow. Lots of macro numbers. I think all the macro numbers are going to be okay, even though GDP declined in this reporting period. I don't think that was any surprise. I think the industry was expecting a decline. But, I sound kind of geeky every time I say this, but I'm watching the 10-year and I'm watching VIX, and that 10-year looks like it's going to 230, and VIX looks like it's going to at least below 11 and maybe into the 10 area. And I think under those circumstances, we're going to see 17,000 on the Dow and 2,000 on the S&P. I don't know that it's going to be a week, a month, but I think there's a lot of good undertones to why money is flowing into the equity market, and I'm watching macro events.
All right, that is going to do it for the Around the Block segment. It's also going to do it for this episode of the Option Block. But before we go, as always, let me check in with my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods that may interest you, the listener. Starting off with you, Senior Rock Lobster. What's cooking in the land of the pit?
What is coming up in the land of the pit? We do have, again, we launched our new gold course. We launched our new chat service. Which is actually, we've expanded now to a couple hours every day, from about 10:15 to 12. Plus we throw in the pit reports. It's almost 3 hours. And it's going pretty well. We got people talking, had a lot of great trading ideas in there. So the clients are happy with it. So it's doing what we wanted it to do, slowly but surely. So it's working out pretty well.
All right. Thank you for that, sir. And Mr. Viceroy, take us home. What's coming down the pike in the land of OX education and live events?
The singing clocks. Saturday, the 31st, this Saturday, Jimmy Ruzan and the team are in Philadelphia doing their all day. That's an 8 a.m. to 3:30. 8 a.m. is really registration. The event starts at 9. If you can't be in Philadelphia, the event is streamed as a virtual event on the site. Come to optionsexpress.com. You don't need to have an account. You can participate in the event just as if you were there. Showcase a couple of webinars. Tuesday, June 3rd, Jim Wyckoff, who writes the well-known Wyckoff letter, very well-known in the futures community, is going to do his monthly futures outlook. And then on Wednesday, June 4th, what's hot and what's not in futures. We always do beginning of the month, kind of what the month looks like going forward. The what's hot and what's not is from Hightower. Again, the well-known Hightower letter. But all the events are free. I only showcase a couple of the webinars. We probably do 60 or 70 webinars a month. They're all free. Just come to optionexpress.com and click on the Educate tab.
All right. And on behalf of Alex and Andrew and even Uncle Mike, who couldn't join us today, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing and for writing in with such great and timely questions. Keep them coming, and we'll see you next time right here on the Option Block.
The Option Block was brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.